delving specifically into taxation, income tax. Obviously, as an individual, you do a tax return every year. If you're a sole trader, then you, as mentioned, you have to record your business income and expenses. There are certain rules about whether, if you're making a loss, you can offset that against your normal income. And there are things like income averaging, which you can access. But mostly, individual tax returns are fairly straightforward. If you've got a business one, they're a bit more complicated as a sole trader. For a company, like I said, the company rate's around 25 cents. It has been coming down to 30 cents. I think last year it was 26.5. So there are a couple of things that vary, but mostly it's a flat rate. So for a company, for a company, you pay tax on all your profit. As an individual, you're probably aware, you get your first 18,200 tax-free. It's a staggered rate, and your tax rate is depending on your overall income. Companies don't have that. They just pay tax on whatever profit they've got. And that's why one of the advantages of setting up a company, like if you've actually got a lot of income coming in as an individual, if you've got $500,000 in fees coming in, say you're producing directed a feature, and you're not a company, then you'll be taxed at the highest tax rate for that. So you can be paying up to 45 cents in a dollar or 46 cents in a dollar on that income. Whereas if you're a company, you might only be paying 25 cents in a dollar in that. Now, there's then a separate issue of getting the money from the company to you personally, and whether you do that through drawing a wage from the company and stuff like that. And that starts getting into tax planning, which I'll go through in a minute. But if you're starting to get higher levels of income, then you can be paying less tax through a company through tax planning. So that's another really good reason to set up a company, is to pay less tax. As mentioned, the company has annual returns. I'll mention GST next, and ASIC fees and everything like that. But yeah, as a company, you're basically doing a separate return. The company has its own income. The company has its own expenses. The company has its own assets and liabilities. And if it generates a profit, then you're paying income tax on the company. If you're generating a loss, you carry the loss forward to next year. And so companies can be very tax effective. Just touching on that tax planning, for example, let's say you got the $500,000 of fees in on a company, you pay tax of 25%. So you've got all this money sitting in a company. You might be developing projects for the next couple of years, having just shot that big feature or something. You might decide to draw a salary from that company for 4 years, and that way you're accessing the tax-free rates on your individual, but you're getting the spread of access that over 4 years for that chunk of income by pulling it out of the company. So you can actually, through tax planning, through looking at, how much salary will I draw this year? Well, I'll draw 40,000 out of the company because that's tax effective. I'm paying a smaller tax rate on that. And so that's generally when you're starting to get your tax accountant involved in a bit of tax planning and going, I'm making money in my company. How do I get the money out of the company into me? And that's when you start looking at salaries and things like that. Just a quick word on entertainment, and I know this will probably disappoint a lot of producers, but having a meeting in a cafe, not a tax deduction. I'm sorry, it's entertainment. It doesn't matter if you're sitting down with a writer having a chat about their project, but basically it's considered entertainment by the ATO, and you don't want to be trying to claim a business deduction for that, because then you're going to be hit with fringe benefits tax, which is a punitive tax at 48% or something. So I know it feels unjust because it's a business meeting, and it's a business meeting in a cafe, but it's one of those things that, especially as producers, you can have lots of meetings in lots of cafes, and unfortunately they aren't tax deductible. If you're having a meeting in your office and you get coffee into your office, then that would be tax deductible, but meetings in cafes are considered entertainment, and you don't want to be claiming those as deductions. So GST, you can report GST quarterly, which is called a quarterly BAS, in which filling in a form and telling the ATO what your sales have been, how much GST you've collected for them, how much GST you've paid, and at the end of that, you're actually getting some money back or paying them some money. A lot of people see GST as an expense, and it really isn't. GST, you're basically collecting money on the behalf of the government and then paying money to other people who are collecting money. So GST is never really an expense. It feels like an expense because it impacts cash flow, but it impacts cash flow because you've brought more money in, say, on your invoices. You've charged an extra 10%. So that means you've got to pay that money to the ATO. And a lot of people think, oh, God, I've had to pay so much GST this quarter. But that's money that was never yours anyway, because you just collected it on behalf of the government. So GST, you get to claim your GST on your expenses, you collect some GST, and really the government makes some money on GST when at the end user stage, when somebody buys it and they're not registered for GST, they pay the GST and they can't claim it back. So it's really sort of like an end user tax. If your income is less than 75,000, you can just do an annual GST return if you decide to register when you don't have to. And some people do that because that just means you've got to do it once a year. But most people will do it quarterly, just from the point of view, if you did an annual one, you're getting hit with GST once a year, and that can actually impact your cash flow. Most people actually would rather pay it quarterly because they don't build up then a big GST debt if they're invoicing a lot of GST. So most people will do it quarterly. PAYG, which is the money you're collecting from your employees, you can choose to do that quarterly as well. So you can pay the money to the ATO that you've withheld from your employees quarterly, and that goes on the same form as the BAS. So the BAS could just be GST, or it could be GST and PAYG, because it's just a different part of the form. Quite often, larger productions will actually do the PAYG monthly rather than quarterly, because again, they don't want to build up this huge tax debt on their balance sheet, and they're only going to be employing people for over a 2-month period. So they'll actually go report their PAYG on a monthly basis, so they don't build up this huge tax debt and that sort of thing. So that's PAYG, and I'll just mention payroll tax. Payroll tax is a state-based tax, whereas all of these other taxes are federal taxes. So depending on which state you're in, there are different rules. Payroll tax generally has a sort of threshold where you only start paying it above a certain level. Like I think in New South Wales, it's roughly about 100,000 a month. If you're paying more than 100,000 a month, roughly, each month is different because it's got a different number of days. But like the threshold's, I think about 1.2 million at the moment. I think it might be even going up a little bit. Payroll tax is one of the main sources of income for a state government, so they don't want to let it go. But it's also considered a bad tax because it's a tax on employing people, and economically you want to employ people and incentivize employing people. So payroll tax, I think, over the long term will get phased out and replaced with something else. But because the state doesn't have to go to the federal government and ask for money, which it does to get GST money or company tax money, they don't like letting it go at the moment. So what generally happens with payroll tax is if you have somebody employed for the whole year, you get access to the whole threshold. So let's say you've got a big payroll, you're doing a feature film and your payroll is $500,000, which you shoot in 4 weeks. You can either pay the payroll tax, keep somebody employed for the rest of the year, and at the end of the year, try and get the payroll tax refunded because you've then got access to the whole threshold. Or you can talk to the internal revenue of the state and see if you can get an exemption. Basically, go, look, I've got this huge payroll now, but it's sort of a one-off project, and can we just do an annual return rather than doing a monthly return? And then when you do your annual return, you don't pay payroll tax anyway. So a lot of productions now are just applying for an annual return and not paying payroll tax. Over that certain level, like if you've got a $20 million production, you probably will be paying payroll tax because you'll be up over the 1.2 million for the year. So